Hey everybody, this is Jose Blasco here. How are you, everyone? We are about to get started. As always, let's have a quick chat on a quick message on the chat box. So I know that sound is good. That would be great if you could. Thank you so much. And we are about to get started in just a few seconds. Okay. Thank you, guys. Thank you, Ahmed, Mark, Joe. Hey, Josip. Very nice. Wonderful. Thank you. Hey, Jeff. Thank you so much, everybody. 5 seconds to go. That's it. It's time to go, my friends. Here we go. Welcome to the session, everybody. Today is April 27, 2022. My name is Jose Blasco, and this is Options with Options. This is the place where we trade options, isn't it? So we're going to do that. Before we get started, I would like to highlight a disclaimer on the upper left side of the screen, so you can read it carefully because it is important information. Counting on you guys to read completely. Some of you are regulars of our sessions. Please read it carefully, and if you are new indeed, read it carefully. Thank you so much. Mark, yes. I'll talk about the calendar in a moment. Okay, I'll tell you the story around that. Anyway, agenda. We're gonna be looking at the market, understand what's happening out there. We're gonna be looking at the trades that we have. We're gonna review and see if any management is needed, and from there we'll look into building new trades. That's the plan for today. Before we get started today, I actually have a special announcement that all of you should have noticed, isn't it? Which is the fact that we have a new website. Okay, so I wanted to point at a couple of things here, so you know how to utilize it better. For sure, I'm more than happy to get some suggestions or comments from you guys as you start using it. Feel free to email me and so on. I have the same screen problem again. You mean that you don't see my screen? This is odd. Let me go ahead and do this. So what about now, Mark? Are you referring to the fact that you don't see my screen? Do you see my screen now, everybody? Could you guys please confirm that? The screen is completely pixelated. Very strange. But you see the video stream correctly, correct? Okay. What about now? Do you guys see it correctly now? And of course, we have a few seconds of delay between us, given the video, the networks of video distribution. So your video is fine, but the screen is all messed up. Is that still the case? Because I am looking at this on a different screen, and oh, good now. Okay, great, perfect. Because I see it normal on my end, not only on my computer but also on another screen I have to monitor the session. So I'm not sure why is this happening sometimes. Anyway, so hey, I'm delighted, my friends, to share with you that finally we have our new website out there. Between us, there is still works to be done, some functionalities to be improved or changed or added, but at least we have like version 1, which is going to be a faster and more robust website with less issues. We had a collection of issues before that were difficult to fight. Okay, so I'm very, very happy to share. So you guys, let me know when you have a moment to take a look. If you have any feedback and you would like to shoot an email, I'd be delighted. Okay, I'd be delighted. Okay, only when you have time. Now, a couple of things I'd like to share with you today, very quick, about the website, so you know how to use it. First, the section that we're using, obviously, you click on live trading, which is what everybody has done, isn't it? And you come to this page where the session is taking place. Okay, I'm not playing it here, but you can see the chat box. And then here we have the calendar, which, funnily enough, is not related to the web development. But we had an update today that messed up the calendar. So the calendar is there, but it's not showing the information on the front end, which is something our technical people will fix, fairly quickly, I guess. So anyway, this is gonna be here, okay, guys. So apologies for the fact that it's not here. A few hours ago it was. It's not now after an update. Okay, so mysteries of the technology. And then here you have your recordings. Okay, all the recordings of all the sessions are gonna be found below. So you just pick session. Let's say you want to watch stocks. So here on the upper right, there is a button that you can click and you get the playlist, and then you can just select the video you want and just play it. Okay, that's the live trading section. Then We have the apps section, which is as before, where you find our apps. There is more detail now. There is a pretty interesting section with questions and answers that are often very clarifying, especially for the ones not using the UFOs and so on. So, all of this is here. Then the courses, you may have noticed that we also have added a few more informations about the options course, the crypto course. So we are working on those right now. For example, the crypto course or the options course, if you click on any of these, it's going to give you the choice to get into a wait list. And if you put yourself in here, when we have it released, you'll get a 50% discount. I need to say that for you top users, okay, if you are subscribed to the yearly membership of top, you have access to all the courses for free. For the ones with the monthly memberships, you have access to one course free. So if you haven't used it, you can get this one for free for sure. But if not, you get 50% discount. Then we have the coaching session where you have the various models for the coaching, okay? And nothing new here if you wish. So I'll just, just keep going. And then finally, I get here to a place which is the traders meeting room. And you guys were asking for this, okay? So where do you find the traders meeting room? You scroll down all the way to the bottom, and here there is a link which is traders meetings, okay? So when you click on the traders meetings, okay, you will now have access to a meeting room where you just type your name and you click join meeting, and now you can be there with anyone else, and everybody could be sharing screen at the same time. Everybody could be chatting. Everybody could be turning on the camera at the same time. So there's not really too many restrictions in here. I have it blocked so it doesn't interrupt the session, but you will need to click on allow to make sure that your browser has permission to use your camera and microphone, which obviously it's the key for when you guys get together. This is for you to get together between you guys at whatever time you choose to meet, okay? So feel free on the chat box to share your contact information. Feel free that, get in touch and get in here together, okay? And from time to time, I may pop in, any of our instructors may pop in to say hi. I would not expect that we'll get 24 hours a day people in here, but whenever you choose to, you can go ahead and join any other member of the community and share screen, talk about trading, and so on. So hopefully, this is something that you will appreciate, and this is what you were needing. So as you start utilizing it, again, if you have feedback, feel free to share. A couple of things that I would like to highlight is that there is no moderation. Okay, so this is a tool created for you guys to use. So please, everybody, not that you are not, everybody is, but at the same time, it's important for me to say, everybody be respectful to each other, etc. There are a few simple rules. Be respectful, courteous, be engaged, show your passion for trading, don't be shy, be disciplined, manage your emotions, be kind, help other traders, and all of the above, which I know it's your mentality. Now, let's say someone is not behaving and it's not you, leave the meeting room immediately and report this incorrect behavior. Send an email to support so we'll know and we'll take action on that person, okay? Anyway, so that's the plan. We kept it very free of use, okay? So you guys can use it any way it works, okay? So again, no moderation. This is another home for you guys, in this case, to meet at your discretion. Another news I have for you guys is that we are about to publish our first book, which is also something super, super exciting. It's called Mystery to Mastery Series Forex Trading. Not all of you may trade Forex, but thank you guys for giving me those extra minutes today at the start of the session to give you a little tour of the website. Normally we don't do this. But again, excited to have this book on sale very soon. It's not on sale yet. So again, same as with the options course or the crypto course. If you click on purchase, you can put your name in a wait list, and when the book is released, you'll be able to buy it on the pre-sale, which is going to be discounted, okay? The book will be electronic, but also paperback, and also to be shipped anywhere in the world, okay? So anyway, pretty nice. And what else? And then, of course, as always, the instructors, we also have our page. In my case, is tradewithufos/Jose. And when you come in here, so you will be able to get a spreadsheet, which I need to get organized, but I'll start utilizing soon to also document our trades apart from doing it in SiteUp. We'll start documenting it here. Josip took the lead since some time ago, and he's done a fantastic job with the spreadsheet. So we'll copy Josip the other instructors and try to do as good as a job by putting all the information here. So if you miss a session or you need to reconfirm or recheck something, so hopefully this spreadsheet will be useful to you. And then finally, when you scroll down, you get to the question section, which is what you know, where you could type and ask questions. Okay. So anyway, so this is some of the things I would like to share with you about the new website. If you want to share any first impression on the chat box, more than happy to get it, positive or negative. Okay, if there are things you don't like, I'll take it. I'm a trader. I can take the winners and the losses. Okay, so no issues with that. Happy to just create tools that are useful to you guys. So let me know your first impression, and then if you want to share something a bit more detailed, feel free to send me an email. Okay, cool. Anyway, let's begin with our market analysis. Okay, so today, out of being original, I'll start looking at the VIX. And the point when looking at the VIX is that the VIX is high, right? So if you look at this parabolic move to the upside, it's certainly an intense one. Okay, so it was trading around 20. Next thing you know, in no time, it's trading at 30 plus level. Thank you, Ahmed. Thank you, Jeff. Thank you guys for those comments. So the VIX is high, okay, and therefore, again, you tell me in the chat box, what do we normally tend to like to do when the VIX is high? What is it that we like to do? Please, you guys tell me that. And as you tell me that, I'm just going to move to the S&P and start doing the market analysis. So what do we have with the S&P? Well, the S&P, we have a down climate, okay? We had a little bit of blue the other day, okay, but it was a little bit of a fake one. Okay, immediately the market proved itself to be weak, with a very strong climate, confirmed from the beginning to the downside, red. And beyond that, we reached peaks of ATR spread that were 205, which is double than what a two standard deviation is when it comes to the max distance. So in other words, that market has been moving to the downside way too far, way too fast, which typically tends to not to be sustainable, given the fact that we are reaching, 4 is more than 3, so we are reaching the statistical end of the climate duration. And on top of that, we have surpassed, and even now, as we speak today, we are talking about 147, which is also more than 102. So we are talking about a market that went way too low, way too fast. Statistics suggest it's not sustainable. We have implied volatility for the call still winning the battle against the puts. Okay, very, very shy, not like some time ago before, but much more now. Okay, and therefore, we need to be careful with that, because even though implied volatility for the calls was greater than the puts at that stage, the climate was red, which is the same thing we have now. Okay, so we need to, we need to give ourselves room for us to be wrong in case you were to bet on an up move, because the climate is still red. Okay, so we got to take it easy, but at the same time, it is surprising, given the violence of this market going down, on how the implied volatility for the calls is still winning, blue line being above the gray line. So there are buyers out there. That's what we are that's basically what my conclusion is out of observing options market data. There are buyers out there, but at the same time, they may be at a bit lower levels. Okay, that could be the case. So my intention today, given the fact that the VIX is high, and as Mark said, sell options when volatility is high. Okay. So since the volatility is high, I'm going to be positioning myself on building option strategies where I could catch a potential move to the upside coming, but giving myself a nice buffer to be wrong, in case the market keeps falling. Okay, because obviously this type of violent move tells you two things. In one hand, it's not sustainable based on statistics, but it also tells you another thing, which is, well, these crazy pushes to the downside may be the origin of larger pushes that we could observe in larger time frames, and therefore the market may continue moving lower. Okay, so I want to expose myself to catching a move, okay, because it's likely to get a move to the upside based on statistics. But at the same time, I want to do it with a buffer that allows me to be wrong. For example, if I did it here, when we had this situation of blue above the gray, okay, but the climate was red, which is kind of what we have now, like four dots, same thing. So notice that if you look at what happened since then, okay, the market was trading at this level. The market ended up going way lower. Now, before that, it went higher a bit. So could you have made money on that? Yeah, depending on the strategy employed, indeed. But let's be realistic, not too much and probably not. So the idea would be in a situation like that to expose yourself for a move like that, because if that move was to then continue, which it was looking like it was going to continue with the Elliott wave turning point, blah, 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 if it had continued, it would have been a very fantastic entry point. But not having continued, you want to give yourself room for this to keep falling, because then maybe the move starts from a lower point and then it goes as high, but it may start from a lower point. So you want to give yourself room for breathing space. Okay. So this is the type of trades that I'm going to be looking for today as we review the trades, given the fact that we have that type of climate and we have this type of implied volatility 30+%. It's pretty interesting. Okay. Joe, options volume did not confirm a move up. Yes, they didn't. Okay, they didn't. And actually, it's looking more pessimistic than optimistic. So implied volatility, of course, and puts are equal, but you can see double the amounts of puts traded than calls. Also, volumes have been surpassed for the put, not yet for the call. So plenty of put trading, but are they being bought or sold? Well, I will lean towards being sold. Why? Because the gray line being below the blue line, it means the puts are cheaper, and the puts become cheaper when many are sold. So it seems that double the amount of puts are being sold than the amount of calls that are being bought. This is kind of like the conclusion I would take. So to me, it's bullish. At the same time, the type of trade I'm going to put in place today, it's fairly aggressive. I'm not trading with a confirmed climate to the upside. I'm just trying to take advantage of a high volatility and also a crazy spike on the 8-year spread, which is technically or statistically unsustainable. That's what I want to take advantage of. Okay, and I'm going to position myself in that aggressive mindset, but at the same time, I don't want to be aggressive and close my eyes. I want to be aggressive with a buffer that allows me to be wrong in case I'm wrong, because I could be. Okay, so let's do that. Let's begin first reviewing the trade, and then we'll start putting the trades together. Okay, I'm going to take a sip of water if that's okay. Thank you. So anyway, so let's begin. We're going to be looking at the positions panel. We have very little trades in the account at this moment in time. So we have the G trade. The YAD trade is a trade I never closed in the past, and it's still there. One of these days I'll close it. So the only trade is actually shares of stock. It's not even options. Okay, 100 shares of stock. So please ignore Yelp is there. So the G, okay, that's the one we care about. Okay, and when you look at the P&L of this trade, it shows negative 176, but it's not like that. Okay, when you look at what happened to this trade after the last tweak that we did last week, after all the tweaks, all the rolls that we have accumulated since the beginning life of this trade. So if I look at the risk graph, so we are in a position where we are here. Okay, the current price of the stock is 80.85. Okay, so the PNL is currently here, which is $59. Okay, this is funnily enough, it's a bit more than the maximum theoretical profit for the trade. Which, I mean, from a simulation point of view, from a picking the midpoint of the spread point of view, all of that. So yeah, that's the case. But notice how the theoretical best result of the trade is 54, not 59. So, I mean, there may be times where options have a little bit of extra value here and there, or narrower spreads than normal, things like that. So it happened to me sometimes where I've been able to exit a trade and make a little bit more than what the theoretical P&L was. It's quite rare, to be honest, and normally it's a bit of a utopia, even though it could happen in rare cases. And so nothing wrong with exploiting, placing an order to get out, and hopefully you can get out at the midpoint between 115 and 95, and then you're gonna make $59. But probably I would think that if you place an order of that sort, you won't get filled, and then what's gonna happen is that those options are gonna expire on Friday, and then you're gonna make 54. Okay, this is what's very likely. Why? Because the current value of the stock is 80 something, and to be in pain, you will need to go above this value, which is 86.54 right here. Okay, So above 86.54, now you enter in the pain area, which is the red zone. As long as you are below that, you are fine. So I would say just monitor this trade into tomorrow and Friday session. And as long as you are still in this bottom part, below 86, you are fine. If that market starts going higher, so then it'd be wise to close it manually to avoid moving from a profitable trade to a losing trade. Okay. Looking very good, to be honest, for the trade to end up the way it should. Even if you look at the one-star deviation of the move, which is that magenta line, suggests that we're gonna hit, let's say 83 point something, right? Which 83 point something is below that 86.54 mark. So the trade is looking good. There is nothing else to do but wait. The only thing to do is just to watch it, just to make sure that you don't allow this trade, which is nicely profitable, to next thing you know, become a losing trade because the stock move up too fast. Okay, so watch it very carefully. Okay, now we have earnings. Okay, and this is when I say watch it. Okay, this is one of the things to be watched. Okay, we have earnings. Okay, and now earnings already took place on the 26th, and therefore that's not a factor of risk. But the reason why I am mentioning earnings is because let's say earnings are happening tomorrow, right? And therefore the little e is on the next candle somewhere here on the right. Well, then while the statistical risk graph we just saw, it's telling you, did I close it? Yes, I did close it. So it's telling you that one standard deviation is like 83 something. Let me open it again. So the reality is that with an earnings report, you may have this massive gap up, and next thing you know, while 83 something is the statistical value, next thing you know, the stock is now trading at 92 and a half. That could happen. So if that was to be the case and you are in nice profit, very, very close to the maximum profit of the trade, certainly I would be quite intense in trying to get out before the earnings report to lock in the profit, which is close to the maximum profit. If that's not the case, just leaving it alone. That's my set of rules. Leaving it alone, expecting that market is going to stay somewhere, wherever that is, and likely going to get my $54 profit per contract on this trade. Okay, so that's my review of this trade. And AMD that we have here in the bottom part, that one was closed already. So that's all when it comes to my review. If there is any question about this trade, please let me know, and then I will go ahead and begin with planning trades. Joe, that short put is in the money, and when extrinsic is gone, early assignment is a possibility. Yes, for sure, but not only for the short put, also for the long put, right? So the short put would be assigned, and your long put would be auto exercised, right? Let me bring that back so make sure this is understood. So back to the risk graph. So we are in a trade where we have the 87 put, okay, and the 86 put. Okay, those are the ones we have. So the 87 put is going to be auto exercised, and the 86 put is going to be assigned because you are below 86, which obviously below 86 is below 86 and 87. So all those two options will automatically will automatically have a consequence. It's not like the calls that are going to be out of the money both, and then they will just expire worthless, and that's it. The puts will both be impacted by the fact that they're in the money, and therefore one will be assigned, one will be auto-exercised, and therefore you're out. Okay, you're out for the maximum profit, which is the distance between strikes, which is $100. Okay, so you'll make $100 minus the $46 that this trade cost you. Guess what? That's your $54 of profit, of maximum profit for this trade. Okay, so you are correct, Joe, but keep that in mind that, and I'm not saying this is your case, Joe, but many times options traders have that kind of like built-in fear about, oh, I'm going to be assigned, something's going to happen to the option, I'm going to be assigned. And first of all, putting on the side that there may be reasons to be fearful of that or not, which the only reason to me would be that you didn't know you were going to be assigned, or you don't know what is being assigned, which of course, fair enough if you're new to trading options, which is maybe the case of some of you listening to this either live or recorded, but I would think the majority of you know what's assignment, isn't it? We've done lessons on that before. So while it could be a problem to be assigned if you didn't know it's going to happen or you don't know what it is, the reality is that being assigned is not that big as a problem, especially when you're in a spread. where one option offsets the other one, and then in this case, actually being assigned means a profit, not a loss. So now the other part of the equation which I want to point out is the fact that many options traders have this mentality about, oh my god, I'm going to be assigned, something's going to happen to my account, blah 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 blah, but they don't think about, what about my long options? My long options are going to be auto exercised if they're in the money, and it's kind of like the same thing of being assigned. You have a margin impact, right? If you buy a call, the stock goes up, the call is in the money, and the option expire, you are going to be auto exercised on the call, and now you own 100 shares of stock at that price, which means you have a margin impact. You need the money to hold those shares. If you are selling a put and you get assigned, you are going to be assigned on that put, and therefore shares of stocks are going to be put to you. So same story, you're going to be long shares. It's the same thing. So exercise and assignment is both sides of the equation, just like calls and puts are both sides of the equation. One gives you the right to buy, one gives you the right to sell. Again, I don't want to turn today's session into a lesson day, but you get my point, right? So again, just keep this in mind. Don't think only about which option is the one that is going to be assigned, thinking about it as risk. Think about it from a risk and opportunity point of view, but also think about which options are likely going to be assigned and which options are likely going to be auto-exercised, because both of them in the end convert an options contract into shares of stock, either long or short, depending on call or put, depending on long or short. Okay, so hopefully I didn't make it too long or too complicated, but just keep that in mind. Okay, being auto-exercised is just as normal as being assigned, and in this case you would have both assignment and auto-exercise, assuming the stock is below 86. Nice, very good. Thank you for the question, Joe. That's a very good question, and also I believe you understand all of this very very well. But thank you for the opportunity to explain it for the traders in our community that are newer to options trading, and that was a very good question. Thank you so much, Jeff. You said it perfectly. They offset each other. Very good, perfect. Okay, so let's begin. What are we looking to do? I'm looking to find good buying opportunities as an aggressive buyer because the climate is down. But while I'm going to look for opportunities as an aggressive buyer, I'm going to look for opportunities with that smart buffer that allows me to be wrong and take advantage of the high VIX values, okay, high volatility values in the market, across the board. How can I do that? Well, first, I'm going to be looking at scanning using reversal signals, and I'm going to be pointing at speed bumps of support. Okay, so I'm going to be looking for speed bumps of support. That's the first thing I'm looking for. Okay, for the ones of you not familiar with speed bumps of support, so this is what it is. You look at a relevant turning point, you put a speed bump in here, and when price comes in inside the speed bump from there, many times we get a relevant turning point. Not only a turning point, but a relevant one. Okay, so that's what I'm looking to do. For example, in this case, I'm not sure about this. Okay, I'm just trying GE in this case, but in this case it didn't come here. What about in this case? It didn't come here either. So but there are many cases that when you have a turning point like that, the next turning point is originated from those speed bumps. Okay, this happens many times. So I'm looking for that type of setup, but instead of looking for this manually, I'm just scanning for it using the matrix. Okay, so my first filtering condition is speed bumps of support. My second filtering condition is I want options to be pricey. Okay, most options should be relatively high given the fact that the VIX is high, but it's not always the case. So I'm gonna shoot for expensive options by selecting CIV mean greater than the 80% range. What else do I want? Again, I'm looking for stocks that have been falling hard with expensive options entering those speed bumps where significant turning points often happen. Great. But what do I want about those stocks? What else do I want to increase my odds? Well, I want those stocks to belong to groups which are strong up. I don't want to buy stocks that belong to groups which are strong down. Okay, so those particular three stocks at this moment in time, they belong to this type of group. Okay, so I'm gonna select that, nothing else. Also notice I selected long term. Okay, why? Because I mean, I could select short, but notice what's going to happen if I do short. Zero. Why? Well, because if the stock is falling hard into a speed bump, well, the fact that that stock is falling hard probably is having an impact on the sector, or the sector is making that stock to fall. So in the mid-term, I'm okay for the sector to show some weakness as long as in the long term that sector is strong. Okay, so that's why I'm looking for strong. So I give the stock the opportunity to fall hard. Falling hard equals buying at a lower price, and I want to focus on that. Okay, so we got that. What else? I'm going to be using my classical list, okay, which often is very restrictive, but I like to start with restrictive. When it comes to strengths, nothing earnings. I would like to exclude earnings in less than 30 days, so it gives me time to get to my target. And then I would like to look at auto climates, which in a perfect world, they would be down, and not only down sensible, that would be down late. That would be great. Okay, even though, to be honest, in this type of setup, auto climate could be ignored. But if the climate was to be strong to the downside and late, that would give me even more odds. Nothing is that exaggerated, okay? Which I'm not surprised. Why? The S&P has been falling for 4 days. We got 4 dots in the down climate. So I guess if I look for sensible or something like that, I may have a few more opportunities. No, I didn't. Oh, okay, yes, I know, because I'm filtering with my scan list. So if I clear that list, I may have a few more. Yes. If I filter with late, probably I have a few less. Here we go. Okay, that's what I wanted to show. So in other words, for this type of application, you could certainly check if you have these very extreme auto climate conditions, which is going to help the trade. But if you don't have it, in my case, I'm okay with disabling auto climate, because we're going to be looking at some unique opportunities. Okay. Now, the issue I have here with those unique opportunities I found is that when I add my list of penny increment options, which is my favorite way to do it, when I scan, actually I got nothing. None of those symbols were stocks with options that trade in pennies. So in that case, I'm left with like, so what do I do now? Okay, so what? 2 choices. Either open up for more stock symbols, which for an application of this sort, I wouldn't mind. Because again, we are looking for unique opportunities in the market. Okay, and unique opportunities in the market are often found in stocks that not everybody trades. So for this type of application, I would have no problem to be more flexible with my list of stocks. When I'm doing trades which are more like non-directional and I need to, for example, maintain an iron condor and roll the put side or the call side, I need more liquidity, I need more stuff. So, I'm going to be more stricter with the symbols I use. But when I'm looking for like very unique opportunities in the marketplace, I'm more open to other symbols that may not be the classical symbols, if you wish. Okay, so that's one thing. But before I get to open the door about more symbols, I also want to look at other ways to look at inflated options. Okay, it doesn't need to be CIV mean greater than 80. That for sure is going to be expensive options. But we can also look at expensive options, as we've done many times, as CIV mean minus historic above the 2 standard deviation. And if we do that, we may be lucky and we may have some symbol. No, we don't. Okay, so then choice number 3, remember we have 3 choices on how to look at implied volatility. So choice number 3 would be to look at the options that have increased the most, the CIV mean that has increased the most in the last 5 days. And in this case, we got Tesla and Verizon. Okay, so this is where I'm going to start now putting the trade together. Okay, so now if we look at Tesla, for example, okay, implied volatility is not as high as 85, which was right before earnings, okay? But volatility is certainly quite high, okay? And probably it has a lot to do with lots of speculation because earnings already passed, not too long ago, actually. But of course, we all know the story happening, right, with Mr. Elon Musk and Twitter. And so all of those things may have an impact in, other companies owned by Mr. Elon Musk, and I'm not surprised to see this peak of volatility on Tesla. So obviously, being able to grab that volatility at a rate of 66 is good. Okay, it's a good thing. Okay, so I'm open to it. The other stock is Verizon. Okay, and when we look at Verizon, also pretty high volatility. I mean, we are not talking about 30 plus something, so it's not greater than 80. That's why it was not in the filter before. But this great increase in volatility, again, is out of the stocks in the market that in the last 5 days have grown the most with implied volatility. So this, together with the fact that the VIX is high, well, you are not selling cheap options here. Is that making sense? Those are our three methods. Okay, and I want to kind of summarize it because it's been a while that we didn't see that. So method number one, to look for IV mean to be greater than 80. Okay, this is kind of like looking for the best case possible. Case number two is to look for historic volatility and CIV mean, the difference to be above 2 standard deviations. That's the second best case possible. And the third case will be the greatest increase of volatility in the last 5 days. Again, while implied volatility in options trading is absolutely critical and very relevant, it's not like we need to be millimetric. Okay, it's not like when you decide on the buy or sell price of, when you trade futures intraday, for example. That's not the case. Okay, so it's okay to be flexible and and have a little bit of wiggle room here with what we define as expensive and cheap options. And I guess you are with me on this concept, and certainly using Verizon with options at 27 or Tesla, it's certainly an option that makes sense. Okay, so let's now go ahead and start looking at the technicals and be able to quantify this trade better. Okay, so what do we have? Well, if we look at Verizon, I started with Verizon, and we click on this bottom low. Okay, so we can see how the price is inside that speed bump. So if we click on that bottom low, price is not. Okay, so that bottom low is not relevant. This is not the bottom low that was being used by the matrix. This is the bottom low. Is actually the prior one. Also notice I got my, if I right click, edit study, I'm using my pivots, okay, which are the little black triangles. So that's why I click here, okay, and that's exactly what the matrix is doing actually to find those opportunities. Okay, just giving you a little bit of insight. Okay, insight. Let me see a few comments on the chat box. Let me take care of that before I continue. Joe, is AutoClimate late almost the same as TSL4? No, it's different. It's different. TSL is more of an indication of strength, where climate is more an indication of what's likely going to happen next from a duration point of view. So it's two different things. Okay. Now, could you add them both and combine them both and look for a very late climate, which is TSL -4 on top of that? Yes, of course. Would you have confluences at times? Yes. Is it going to be all the time? No. Is it going to return less results? Yes. Why? Because you are pickier by filtering by more by more parameters. So again, it all depends in the end on you, right? So let's say you are a person, let's say, I'm just going to pick up an example. You are super passionate about the markets. You love it, love it, love it. You cannot live without the markets. You love to spend the whole trading session in front of 10 monitors you have. And on top of that, you have plenty of time available, so you can do that. So, okay, nothing wrong with filtering out by so many parameters and checking many times a day and things like that. On the other extreme, let's say you are a very busy person. You only have 1 hour to look at the market. You need to look at the markets quickly, find your trade, place the order, and go. So then, it would be justifiable to be less picky. Okay, it's like everything in life, pros and cons, and in the end, to me, it's better to be less picky and trade more often than because you are so picky. Then next thing you know, you never trade, right? So again, this is for you to define, but just my 2 cents. Ahmed, I used the same scan and I got more stocks than you, Jose. Are you using the same parameters as well here when it comes to my minimum price, the minimum volume average? Are you using exactly the same, Ahmed? We should get the same, okay? Or maybe the list of stocks here, we should get the same because this is coming from our cloud server. This is not processed locally on your computer. Okay. Cool, perfect. Okay, so let's continue with putting the trade in place. Okay, so we have the trade set up. Okay, so we have that opportunity identified here. So now, of course, what else do we need for the trade to work well? Well, again, we are expecting that out of this speed bump, the price moves. But what is it that we really like to see for us to have a good confidence that something is going to happen beyond what statistics or price projections may suggest? Well, we'd love to see some green UFO somewhere here, isn't it? So if we got some UFOs here, we can start selling options around these price points and build our trade around these UFOs, meaning that this is our entry point, and from here to here, that's the buffer. From here to here, that's the buffer that allows you to be wrong by a certain amount, meaning that if this market didn't turn starting from here and had to fall a bit more before finally turning and go, So this size from here to here, that's the buffer I was talking about, right? So we need some UFOs somewhere around below price for us to rely on those and sell options there to build our trade strategy. Okay, so in this chart, I don't have UFOs. Okay, in this chart, I don't have you. By the way, I'm looking at a 2-day chart. I should be looking at a daily chart here. So in this chart, we don't have UFOs. Okay, but why is that? Well, if we look at the monthly time frame, okay, it's been a long time. We have not been at levels of this sort. So that was in 2018. Okay, so I'm just gonna go ahead and load more candles to see if we can find UFOs further. Okay, so I'm just gonna go ahead and load the maximum, which is 10,000. Here we go. Here are the UFOs. Okay, so that's the buffer that allows me to be wrong. Okay, from 48 to 47, that's the buffer. Okay, you can also build it with the UFOs below, but of course, the lower you go, the bigger the buffer you build for you to be wrong, not to be hurt. The bigger that is, okay, in the end, the less deltas the trade will have, and then if you get a move to the upside, starting from that speed bump, is not gonna pay you too nicely. Okay, it's not going to pay you too nicely. Okay, so in that sense, I rather go for a UFO, which is the nearest one, somewhere around or below the speed bump, which that 47 UFO is ideal because of that reason, but also because when looking at the stats, it provides 59% probability, and that's more than 50%, which is our minimum to be directional. Okay, so we have a case. Okay, we have a case, my friends. Let me see. Mark, is it the trust station versus the top version disparity, or should we look for reversal candles at the speed bumps? Okay, so Mark, the reason for the different data between Ahmed and myself could be the difference between the transition data feed and the QC data feed. It could be. I would not think so, but it could be. Okay. Ahmed, you are talking about using candlestick formations. That could be another very wise approach, by the way. Okay, so you could say, look, I want this to be on a speed up. You could actually add this to the matrix. Okay, so you could save that scan to a list. Okay, save it. Okay, and now that you have it, save it. Sorry. Okay, now sorry for that, guys. Save it, and now that you have it, okay, you can go ahead and select daily bullish candlesticks, or maybe you want to look for dojis, for example. Okay, in this case we got none. I mean, we started with 2 symbols, so it's very little. But for the days when the market is crashing hard and you are concerned it may not reverse, you may want to do this. So you wait the next day, right? And with the list of symbols you created on the day before, so now on the next day, using those symbols, you now look for bullish dojis, bullish haramis, any sort of candlestick pattern which is bullish, and that may be a bit a little bit of a smarter time for you to go ahead and put the trading in place. Smarter, I'm defining smarter as trying, smarter as a mindset where you're trying to get a stop out. Of course, there is a price to pay for that, which is now if the next candle is a doji candle or a harami candle or whatever it is, something bullish, probably the markets are cooling down and probably you're going to get less premium and therefore your trade will have a bit less deltas. Okay. That could be the price to pay for this waiting for a bit more of a confirmation, if you wish. Okay, nothing wrong with that, but that would be the consequence. So hopefully this gives you a way on how to do it for yourself. Okay, talking about you guys being busy and maybe you only have 1 hour to trade, and let's say on one day, the market is crashing like the world is ending, and you see that in the news while you're driving your car or something like that, and next thing you know, you go home, the market is closed, and you run the scan, you pick all those stocks that ended up at the end of the day inside of a speed bump, you save that symbol list, and then the next day when the market opens, before you leave home, right, so you turn on top, you now scan that list with bullish candlestick patterns, and now if you have any of that, you place a trade and then you go. Okay, so that could save you a lot of time. And when the markets, I mean, it happens to all of us, isn't it? That there are days, for a few times a year, all the time, that it's like you get push notifications on the phone, you get people going crazy on the radio, on the news, people saying, oh my god, the world is ending, the market is falling 2% today, the market is doing whatever. So when you have days like that, you can scan for speed bumps and then act next day only if you got those candlestick patterns, because what may happen when the days are falling very hard, for example that day, is that then it continues. Okay? So you just wait until one safer candlestick formation forms, and now it's going to be a safer trade, even though you're going to get less premium, but it's still quite okay. So good idea, Ahmed. I just thought of adding a little bit of the how to look for that. Hopefully that's useful. Yes, you're right. Also on the matrix, you also have options to choose reversal signals based on 3 bars up, all that stuff. To be honest, I'm not so fan of those. Okay, just because of the way how I trade, and also one of the reasons why as well is because even two, which is the smallest number here, that means 2 days. So it's like you saw something today, and now you need to wait 2, 3, or 5 conditions for you to now decide, okay, I'm going, right? So it's a bit too much of waiting time for me, even though, to be honest, some of these conditions don't imply waiting 5, for example. It may mean that the 4 player candles did something and today's candle is doing something, so at the end you're waiting 1 day or one candle. But yeah, in some cases it's a bit more waiting time than just using those bullish candlestick patterns, which are simply looking at the last candle or the current candle, if you wish. So yeah, just my 2 cents again. I would strongly suggest that you experience with it and you find your likings. Okay, great ideas, Ahmed. Love that you're exploring the platform in all its magnitude. Love it. Anyway, so coming back to this trade, okay, we got 30 minutes before we go. Let's put the trade in place. So the idea here would be to go ahead and take advantage of the fact that options are expensive to sell puts, but at the same time, selling puts has a consequence, which is the fact that if the market falls and just keeps falling, then you are opening up for a major risk below price, right? So if you sell puts and the market keeps falling and falling and falling, you're going to be assigned with no protection because it's only a short put, and therefore now you own shares of stock that kept falling down. Again, you may have reasons to believe that it's okay. Maybe Verizon pays good dividends. Maybe you are a fundamental trader. You look at fundamentals. Again, there are a million ways on how to trade, and it's all valid as long as you have a plan. Okay. So one action could be sell puts, and in exchange for the put you sold, go ahead and buy calls at a higher price, at a higher strike point, Okay. What would that do to you? Well, what would this do to you is that you have positive deltas overall, and then from there, if the market rallies, both the calls and the puts make money, and you are making money quite nicely. If the market falls, then the calls are losing money, and the puts too. But as long as price remains above the puts, which is 47, so you are losing money temporarily as you are approaching the expiration date. Time decay will reduce the cost of that put, and since the call price was paid out of the premium collected from the put side, so as long as the stock remains above 47, even though it went down versus your entry point, then you are breaking even and you're fine. Now, of course, if the stock just goes down all the way, so you're going to be assigned at 47. If it keeps going below 47, then you're going to be in a net loss. Okay, so that would be kind of like the outcome of this trade. So it's indeed a valid approach. Okay, and we can certainly plan for this setup, which has a little bit of it's an active way to be an investor, if you wish. But I'm calling it an investor because, worst case, you get stock put to you, so you own shares. Okay. Another way to exploit this situation is also to buy calls, but instead of simply sell puts, you would also go ahead and below the puts you sold, you would now buy puts. So basically, you have a put spread below price, You have a put spread below price, and that put spread is paying for the calls you buy. Now, what's the beauty and what's the problem? The beauty is that now, even if the stock drops to zero, the most you can lose is the distance between puts. So you have limited risk versus unlimited risk on the left. That's the beauty. The problem is that, of course, because you buy a put, the net credit left, it's very tiny. So typically your calls are going to be very far away, and therefore your delta is going to be so tiny that it's not going to work too well unless you do 2x. Okay? So you do 2x, you sell two puts, you buy two puts. You have double the risk, but it's limited, versus selling one put, where even though it's only one, the risk is unlimited because you own the stock. So now you sell two puts, and now this is going to give you more premium that may allow you to buy a call a little bit closer, and therefore you get more deltas overall. So that's what I'm going to do. Okay, that's what I'm going to do. Try to buy calls somewhere, a little bit above price. Okay, and sell the puts, ideally, align with that 47 strike. Now, the other part of the equation is, what about my targets and what about my expiration date? And please feel free to ask questions. I need to kind of get moving because the end of the session is approaching. But if you have questions, please type it and type them on the chat box, and I will be watching. Okay, guys. So with this strategy set up in mind, so what I want to do here is I need to define first where my target would be, and also I want to also define the expiration date. Okay, so for the expiration date, I need to be very well aware of the earnings, which are happening on July 20. Why do I need to be aware of that? Well, because you may be in a trade that is moving your way, you are profitable, all is good, but next thing you know, earnings take place, and now you had a gap against you all the way, and for all this time, for like 2 months, everything was good, and next thing you know, now on the last week, everything is a disaster, right? So we need to be aware of that, and ideally, you would want to use the earnings date from, the expiration date from before that date. Okay, so let's take a look at what would that be. So I'm going to look at Verizon. 7/20 is the expiration date. We got 7/15. Great. 7/15 is the longest expiration date. Okay. Prior to that earnings date. Okay. So we'll be out of the trade before earnings, so no risk for gap. I'm okay with that. Okay. And of course, we'd like to see 47, but there is no 47. Okay. So it looks like we need to shoot for 45. Okay. So we're going to do that in a moment. And then now that we know we're going to use July 15, what else do I need to define? Well, I will need to define my target. Okay, and of course, you could. Number one, if we assume that we're going to be right on the trade and the speed bump is going to create a turn, that's going to create an up climate, and therefore that red UFO is not relevant to me, because in an up climate, sell on-field orders tend to be canceled, and buy on-field orders tend to be added. Okay, so we may see a green UFO there anytime where the red UFO was. So that, assuming I'm right, if I'm wrong, it's going to fall, and then I'm wrong. That's it. But if I'm right and it goes up, then that red UFO is not of a concern. Okay, so what would I do? Well, option number one, be very optimistic and plan to reach a target all the way at 54, which is very optimistic. Okay, another idea that could be better is, there is an open gap there. Okay, where the gap started at 50.28. So probably using that 50 level as a target makes sense. I would like to quickly observe the 55-minute time frame to see if there are UFOs anywhere around that level. Oh, I'm just noticing that I have so many. I have 10,000 bars loaded, so it was taking a little bit. Yeah, so around 50 there is no UFOs. Okay, the next UFO is located around 52. So you know what? I'm going to set the target to be 52. Okay, because while the gap started a bit lower, okay, there is no on-field orders until we get to 52. So I'm going to set my target to be 52. Okay, cool. So let me draw a line. You know what? I will do it here. So then we can always go back and review the drawings. So we are looking to get a target at 52. Okay, that's going to be our target. And we are planning to enter this trade on today's candle. And again, the way to put it together would be, okay, so number one, I'm going to be selling the 45 put, okay, using July 15. That, as you can see, pays me 81 to 85. And therefore, I would like to buy a call, which the one I could buy with that amount of money is not the one which cost me 140, is the one that would cost me 59. So this is the one I would buy. Okay. Oh, sorry, I just clicked wrongly. Let me do that again, like this and like this. Okay. So I'm selling, as you can see here, the 45 put, and in exchange, I'm buying the 52 call. So that's trade number one that will give you a 46 delta. Not too bad. Plenty of benefits of doing this type of trade, but also remember, if the stock falls and goes below 45, you're going to be put stock shares. So doing this particular trade is only something that you should consider because you are open to take delivery of the stock. Okay, so this is case number one, which I have here on a graph. Okay, as you can see, if it goes up, you make money. If it goes down, you lose money, and below 45, you lose money at the same rate as owning stock. Okay, cool. Now, what about doing the spread? Well, if we do the spread, and this is going to be a little bit of a higher risk trade because the strike price increment is $5 at a time. So it's what it is. Okay, so if we were to do that, so I would do the put that we sell, and then I would buy one below, which is the 40. Okay, now this I would do it twice. Okay, I wouldn't want to do this twice. Notice that if you do it one time, it's going to pay you 50 cents. So if I do it twice, it's going to pay me $1. So now the question is, with $1, what can I buy? Okay, and the one thing I can buy with $1 is actually the 57. Okay, it's the same strike, unfortunately. So I'm not going to get too many deltas here. Okay, I'm not going to get too many deltas if I do this. So notice if I buy the 52.5 call, one of them. Okay, so let me zoom in. Oh, actually, it's better than what I thought. If I sell two of the put spread, 45.40, and I buy one of the call, actually I get a delta of 51. I was expecting this to be lesser. I'm not sure how I thought about it. Fair enough, we got double the puts, but still with the put spread, I was expecting this to be lesser. Anyway, good news. So what if we do this? Let's compare. So you see the risk graph. So if we do this, and I add one, which is the 40, and that would be a put. Yes. So this is the one we just said. So you see the difference here. No, this is not correct. Okay. Yes, I'm missing one unit. 2. Here we go. Now, yes. So the difference is that with the orange color, your risk is limited. You see how the line goes flat? Your risk is limited. Of course, the distance between strikes is $5 and we got 2, so it's going to be close to $1,000. The risk is $957 if you do it like that. But if it goes up, here we go. Now you can make a pretty decent profit on the trade as the stock goes higher. Okay, if we go to 52, okay, so this trade, we make $200, $200. So the performance is very similar. One got limited risk, the other one doesn't. Okay, so valid approach, knowing that as that stock starts moving, then we're gonna act on it, and then we're gonna sell calls against the call we own, and we're gonna do a series of things as we've done in the past. Some of you may remember. So we'll do that, but this will be our starting point. Okay, so I'm just gonna put the spread in place, and I guess we're meeting tomorrow again. So I guess that tomorrow, let's see what's happening in the market, but maybe we can do Tesla tomorrow or look at other opportunities depending on market conditions. But for now, we're gonna put this trade with Verizon in place. So I'm just gonna go ahead and load Verizon. How is it going, everybody? Any question? You have been very quiet in this last portion of the session. I'm guessing you are just getting all the data on your screen as well and using your trading platform, but we are about to conclude, and I would really love to complete our session. with confirmation that you guys are with me, that all is understood. Okay. So here's the trade I'm trying to put in place. Okay. It's a trade where I'm selling two of the 45 put, buying two of the 40 puts, and then buying one of the two. Let me rephrase that because that was very confusing. We are selling two of the 45 put. We are buying two of the 40 put below, and then we are buying above one of the 52 and a half call. All of this is supposed to produce a credit of around $40. So I'm just going to place the order and see if we get filled. And if not, I will push it because I want it filled so we can track it in the future sessions. But in your case, just make sure you negotiate the entry price properly, okay? Very good. Mark, you're busy with putting this together. I get you. Now, again, what I don't like about this trade, the trade is valid, okay, based on the rules that I use. But what I don't like about this trade is the fact that strike price increments are $5 at a time. So it basically creates a $1,000 risk trade. When the risk is significant on a stock, in this case, a stock that belongs to utilities, which, those stocks tend to be not that volatile, even though there have been times where they're actually quite volatile, but most of the times they're not that volatile. So I would, and they pay an okay dividend. This is a kind of stock where I wouldn't mind to maybe doing it just with a put, and if it's put to me, I'll have some shares of Verizon, and I'll do cover calls or I'll do whatever on it. So I wouldn't feel a problem to do that, and I would feel that it's a more intelligent approach versus taking a $1,000 of risk out of a stock that may not be that volatile. Okay, with Tesla, it would be a different story. With Tesla, I would no way I would get a short put because Tesla could, you could get put on Tesla, you get shares of Tesla, and next thing it drops 40% in one day. This could happen, even though the lead person in that company is even building rockets that go to the space. You get my point. I mean, million% of respect to Mr. Musk, but at the same time, all these crazy craze on social media, buying companies, things like that creates a lot of risk for whatever the stock shares will do in the marketplace. You can see now they're talking about a company which is absolutely not related to cars, which is Twitter, and next thing you know, Tesla, which is a car company, is really moving quickly. Okay, so again, Verizon, I would say, is a different animal, and therefore, in a case like that, I'd be okay to just sell the put. But again, just sharing those different points of view for you guys to evaluate, and depending on your mindset, your purpose for trading, your trading plans, and so on, so you can decide what may be best for you. Okay. Very good. So I'm in the trade. I got filled. Let me take a look at the fill prices. Let me document this, and we'll call it a day. So I got. For the 45 put, I got 82 and then 32. So I got 82 and 32. And then for the call, I got 58. Cool. Have it here. So I'm just going to now copy this position to the clipboard, and I will just. I should delete AMD. All of this is over, isn't it? So here is our Verizon trade, and we have it. My friends, my pleasure as always, and a special day for me. You are the first ones who saw the website out there. So I'm very happy that finally we have the new version of the website, and again with some improvements coming. No one said anything, guys. You gave me very few first impressions. Not an issue. The session is supposed to be for trading, not for you to share impressions. But I certainly, before we say bye, I'd love you if you could share with me your impression about the meeting room, which I didn't get in because I'm currently using the camera with the training room, and I cannot share the camera in both places at the same time. But the fact that there is a meeting room where you guys can meet inside and so on, I'd love to get your feedback from that. If this is what you were looking for, I know many of you are planning to team up and get together and trade. And by the way, guys, remember this is an unlisted stream on YouTube that only us as connected live we see. So if you guys want to share your emails on the chat box so you can connect with each other, you can do it. I cannot share your emails with other members of the community because of the privacy laws, and obviously our company respects that. So I cannot share emails, but you guys are free to share using the chat box, and know that only you guys today now here would see it. For the ones of you watching this recorded, you will see the recording, but you will not see the emails. So it's kind of private if you wish, and if you want to do that, so you can then connect emails, phone numbers, WhatsApps, whatever, so you can get connected. So you could do that. We will likely add more tools for communication, like WhatsApp groups, Telegram groups, things of that sort, so you can also communicate apart from being inside the room. But we'll do things one step at a time. And certainly, I'd love to get your feedback as you meet and you use it, so you can maybe share ideas, good practices, whatever, so we can help you better with whatever. Okay. Thank you, Ahmed. I am selling the 45 put and buying the 40 put. No, no, I'm not. I'm selling the 45. You can see -2, -2, 45, +2, 40 put. Did I do the opposite on Think or Swim? Don't tell me I did that. No, I did right. I sold 2 of the 45, -2, and I bought 2 of the 40. Yeah, so that's what I've done. Okay, I don't think I made a mistake there. Could happen. Yes. So yeah, always important to review these things carefully. Okay, often in the sessions, to be honest, I rush a bit into order placement, for the reason that I want the trades in the account. So then we can talk about it in the next session next week. But when you trade and it's real money, you should never rush into order placement. Okay, this is one of those times where you take it easy. Okay, cool. Okay, so hey, my friends, I will say bye now. See you soon. See you as soon as tomorrow, same place and time. And again, let me know if you want to shoot an email with feedback for the website. More than interested to listen from you. If you have nothing to say or you're busy, it's okay, guys. Okay, you'll tell me another time. No worries. Take care, everybody. Bye bye. Oh, you're getting weird results, Mark? Can you be more specific? Happy to wait a moment and hopefully help you, but please be a bit more specific. I wait a few seconds for you to type. And also, worst case, take a screenshot of the screen so you can have this information. You got 165 credit. Are you using the right expiration date? Are you using July 15? This is very strange. 165 of credit. It's a very good news, but to me, it's probably you're using the wrong expiration date, or maybe you got a higher call. Maybe you bought the 55 call or something like that. Is that possible? Maybe. I mean, we are looking at real-time market data right now, and it's very different. So it's more than double what you got. So what about this? Again, I'm concerned if there is any issue that took place on your end. What about this? What about you take a screenshot of your screen and then you paste it using that tool? Okay, you paste it using that tool that I placed on the chat box, snipboard.io, and then the resulting link you paste it on the chat box. So then I can open it and I can see what you see on your screen. Would that be okay for you, Ahmed and Mark, to do? If you got 165 with the same options, then you are using the best broker in the world. They gave you an incredible pricing if that's the case. talking about spreads between 28 and 33, 81, 78, and 60, 59 and 63. So it's not even like it's an illiquid stock and you just got filled at a fantastic price. There is no fantastic price because the spreads are narrow. So I'm shocked by the prices you guys got. Let me know if it works for you to. Oh, got you. Amen. Okay. Okay. Got you. And Mark, if you're trying to get a screenshot and pasting it, great. Happy to wait. If you prefer not to, or you prefer to take it easy, look at it carefully, and then send me an email, you can also do that. Anything that you think is best. Okay. But let me know on the chat box so I know if waiting makes sense or it doesn't, but also because we have more people waiting. So um, let me know. And also, Christian, one has to be careful. Okay, got it. Perfect. Good, my friends. We keep each other accountable. We help each other. It's what it is. That's one of the reasons why we do these sessions, isn't it? So it's all good. Great. By the way, Joe, I owe you an email. I'll get back to you. Christian, I didn't see your name today. You may be watching this recorded, or maybe you're here and you just were silent. I owe you an email too, so I'll be catching up with that. Sometimes it happens that I get a bit delayed with the emails. Okay, but I always go. I always come back. And if that's not the case, please tell me. But I assume I always do because I took that very seriously. So, you guys wait for me. I'll come back to you with those emails and see you tomorrow, everybody. Take care. Bye bye.